Lots and leverage. Two very, very important things in trading. Way back when, the minimum amount you could trade as a retail Forex trader was one lot. That was a standard size, which meant you would need at least 100,000 of whichever currency you were trading just to place the trade. So imagine needing 100,000 US dollars in order to place a trade. This automatically put Forex trading into the hands of those who have a lot of spare money and not really available to the average Joe on the street. With the advent of personal computers becoming commonplace and able to run millions of calculations per second, as well as the internet being able to connect people to massive data centers so easily, a new market was created. Forex brokers started emerging and found a way to use leverage to allow people with smaller amounts of money to be able to trade as though they had larger amounts. We'll get into that in more detail. For now, these are the basic terms when looking at lot sizes. Most brokers will offer down to micro lots and very few offer nano lots. I believe the reason for this is that nano lots are almost completely pointless. Micro lots are already only 0.01 of a lot and you average 10 US cents per pip or 1 cent per point. So a nano lot would be 1 US cent per pip or a tenth of a US cent per point. Think of leverage as how much you have versus how much you can trade with. For example, $100 would let you trade with $40,000 on a 1 to 400 ratio. So let's say you have $1,000 at a 1 to 500 leverage. That's $500,000, which means that on a standard Euro US dollar chart, you would be making or losing $50 per pip. That's only 20 pips loss and you have burnt out your account. So you can see how bad using a high leverage and leveraging your position all the way up can wipe you out very quickly. In the strategies we teach, we aim to risk only 1% of our trading account on a trade. If you're starting small, but then you might want to risk a little bit more to get early gains, but definitely no more than 3% on a single trade. This will become clearer as things go on when we're covering the actual strategies. Just please keep in mind that people advertise leverage as how much you can make. Rarely do they show how much you can lose. I personally don't even check what my leverage account is anymore because I find that sticking to the 1%, you rarely get very close to even using it. We have various types of orders available to us as a Forex trader. We have the market order, instant execution. A market order is an order to buy or sell at the best available price. It is an immediate order with no pending details. It is quite simply the easiest order to place and the most commonly used. Limit entry order, i.e. buy limit or sell limit. This is an order placed to either buy below the market or sell above the market at a certain price. This falls under the pending order category on most platforms. Let's say the pound dollar is currently at 1.69. You could set a limit entry order to buy if the market reaches 1.695 or sell if it drops to 1.685. The idea is that you can place this order and walk away. It's most commonly used when you believe the market will turn after reaching a particular price. We'll cover this more in the actual training, so don't worry too much if you don't understand everything up front. The other type of pending order is a stop entry order. For example, the buy stop or sell stop. This order works in reverse to the limit entry, where you will buy above the market or sell below the market at a certain price. This is generally used when you believe that if the market hits a certain price, it will continue in that direction. So let's say the market is on 1.695. There is a nice trend forming upwards, but you're not convinced yet. You know that if the market hits 1.698, then it will continue. So you could place a stop entry order that if the market hits that 1.698, or maybe a little higher to be safe, then it will buy. The same works in reverse for sell positions. It is a little tricky and people often get confused at first over this. Don't worry too much. This is more for longer term trading and it will be covered again when we have the platform open in front of us. A stop loss is a very good type of order to learn. It helps you protect your overall capital by setting a market price that will trigger your trade to close. So if you see a trend, enter, and the market swings the other way while you're not at your computer, it will stop your trade. You will still lose some money, just not nearly as much as you could have. A trailing stop is like a dynamic stop loss. If you set your trailing stop at a certain level, let's say 20 pips, then as you move into profit, your stop loss will automatically follow 20 pips behind. This can be very useful for the nervous trader, but sometimes it can also cause your trade to close out quite early on a fake.